Good morning. It is now 11:47, and I will call the Sewage and Water Board of New Orleans Pension Committee meeting to order. Special counsel, please call the roll.
Director Chadwick Kennedy,
Here.
Director Joseph Pacho,
Here.
Director Tyler Anthrop, Director Kimberly Thomas,
Present.
Councilmember Jason Hughes, Ms. Jackie Shine, Ms. Rebecca Johnsey, Mr. Mubashir Magbul,
Here.
Mr. Dexter Joseph.
Here.
Thank you. I'm
You
sorry.
do have a quorum.
Thank you, and please let the record show that Director H. Davis Cole is with us as well. All right, we will now proceed with our presentation items. Our February 2026 Executive Summary and Investment Report for the Employees Retirement System of Sewage and Water Board of New Orleans. Mr. Kwaku Obed with Marquette and Associates.
Perfect. Good morning. And I'll just work through all the agenda items, so feel free as I'm going along just to pause me or speed along the conversation. I know I've probably got some time to make up, but at the same time, I can definitely handle those comments pretty thoroughly. So the first thing I'm going to say is, look, February was a much different period for the markets. So as we think about the next few meetings we're going to have, there's definitely going to be more of a discussion around volatility. So February, we didn't have the escalation of the conflict in the Middle East, which has seen a market sell-off and the market volatility. So some of these ridiculously high numbers, we would have seen a retreat from those numbers. Now, as we get to asset allocation, the portfolio, the really good news here is around the portfolio is how it's structured. We are nicely diversified when we think about fixed income. The infrastructure discussion we're having, even though we're in listed infrastructure, that's also helpful as we think about diversification. So as we think about the broader noise of the markets, think about this portfolio having a good degree of diversification away from some of that noise. So just wanted to mention that before going into the returns. But as we can see here, this is the March 2026 market tracker. So this is a quick update on how last month ended, right? And as you can see, last month, S&P 500 was down pretty meaningfully. Actually went down to -4% and change year to date. So a little over 5% in terms of the loss for the month. The international markets were also down, bringing those returns down year to date. If we fast forward to where we are today, however, your domestic small cap and domestic mid cap are up around 2-ish% positive year to date. So there has been a little bit of a rebound in April. And then the international markets are also slightly positive to the tune of around 2-3% as we think about returns through yesterday's close of business. So again, that theme of volatility, the market swinging up, the market swinging down pretty tremendously, is definitely, I think, shaping the picture that we're in right now. And then on the right-hand side, you're going to see that fixed income was also negative. So fixed income, you'll see, had a negative month, and that's because yields went up in response to everything going on in the Middle East. Yields were projected to come down in 2026, meaning that the Fed is expected to lower interest rates. So going into the year, we actually saw fixed income give off slightly positive returns. In the last couple of days, we've also seen fixed income turn around and give some positive returns again. So end of March, the takeaway is we had a very, very tough month. Beginning of April, it does appear that the market is rebalancing and resurging once again. But as we know, this 2-week truce ceasefire, it's only 2 weeks. So as we get closer to that 2-week mark, the market can either sell off or rebound depending on what the updates would be based off that. And then as we think about the consumer, as we think about the economy, we've discussed this previously, there are a couple of things to think about. So direct impact of the war has been commodity prices going up, energy prices going up. We fill up our cars, we get a sense of just how much that hits our pocket. It's not only at the pump. If you think about the transportation of goods and services, anything that requires moving from point A to point B, you're going to see those prices go up, right? Because the input cost has gone up. So ultimately, as we think about the markets, you're going to see that commodities had a really, really good run, probably for all the wrong reasons, but commodities had a really good run. Other segments of the market saw a sell-off. So definitely a huge turnaround in the market environment for the month of March based off the conflict.
Sorry. So I think this will be a good time, when we have a market like this, a month like this, can we highlight our defensive positions for trustees' benefit?
Yeah,
And
absolutely.
kind of show where that's going, and then
Absolutely.
also as a special caveat, if I'm hearing you correctly, and maybe I lean on this a little too much in Louisiana, when gas prices are high, if we have investments in said energy, we benefit from it.
Yes, we do. So it's two different things, right? Because
Yeah.
there's us as the individual, and then there's the market and the companies that we invest in through the indices. Now, the end result is a little mixed.
Sure.
When we think about, okay, on the one hand, energy prices are doing really, really well, but then let's say, for example, consumer discretionary sectors, they take a hit.
Yes.
Because discretionary spending is down. So all in all, I would say that yes, we've definitely been beneficiaries of the energy price story as we think about the diversification in the portfolio. But there will be parts of the portfolio that could take a hit from the other sector fallout, basically.
But it's a very short-term gain. It's not, because right now, I was reading this morning, the gas came from 115 to 97 already,
Yeah.
the
Yes,
future. So
correct.
it's not really a stable.
Yeah, just for the folks who see negatives, I don't want them to
Oh, yeah,
think
yeah.
that this is
Absolutely.
a doom and gloom narrative. You
Absolutely.
see our net is still positive over
Absolutely.
the rolling 12 months. In
Absolutely.
addition, we have defensive positions that have performed for us. So,
Absolutely.
Yeah.
So we will.
Rico, that's my point. What the chair brought up is for you to explain the defensive positions that we have, and I don't know if you did that.
No, so we're going to get to that momentarily. So what we wanted to do here is just
Yeah.
shape where the market was. Now we'll go into the portfolio, and as we go through the portfolio, we'll start discussing the different segments of the portfolio and how we expect them to behave in this environment.
yes.
But my question is that if we are already vested in different portfolios,
Right.
how can we abruptly change that equation? We are already committed.
Yeah, so we're not, that's a great point and question. So yeah, we're not looking to make changes because to your point earlier, some of this is short-term noise, and that short-term noise, particularly for our type of plan, we're not going to be reactive to it. So at the end of the day, we're staying the course. And the asset allocation, quick reminder on the asset allocation, that is built to withstand up environments, down environments, sideways environments, and that goes into the positioning of the portfolio. Some parts of the portfolio will essentially help cushion environments like this, and then other parts of the portfolio as the
balance it
market's
out,
running. So yeah, great point to emphasize there. We're not looking to make changes. I think what we're looking to do here is just inform on how the portfolio is doing, why the portfolio is behaving, how it's behaving, and then ultimately, again, just reinforcing some of the other discussions we'll have. There'll be a quick education on infrastructure, and I think the timing of that is really good as you think about infrastructure in a portfolio. It's there as a defensive hedge. It's there to bring down volatility. It's there to also have a cash yield that's not correlated as aggressively with what the Fed decides to do. So those will be all good talking points as we think about this return stream. But the quick takeaway here is return stream, portfolios in blue, indexes in gray. We've continued to perform really, really well, both over the short term and long term. Now, this is through the end of February. End of March, the expectation is still for the portfolio to have held up well, given the very strong start that we had at the beginning of the year. So year to date, you can see that we're comfortably ahead of the benchmark. And then as the market has sold off, the expectation is for some of that downside protection to have cushioned some of the downside that we saw in the market. But takeaway here is short term and long term, the picture is good, and the average annual 10-year return has been 9% which is a pretty phenomenal result as we think about the portfolio. So as we think about the various components of the portfolio, again, through the end of February, no surprises here. Fixed income would have been a little bit positive for us. Equities would have also been a strong source of returns. The real estate composite, these are REIT allocations, and the next search, which will be the final phase of searches, will be to look at private real estate, your open-end real estate managers. So once we have the infrastructure behind us, that's what we're going to tee up. So we expect to see less volatility in the private real estate market, but the REIT structure has also been helpful for us as we think about its overall return. And then the infrastructure composite, this is listed infrastructure, has also been a solid contributor to portfolio performance. So as we think about the top performers in the portfolio, you're going to see here some of the index exposures. So even though we are waiting for the contracts to get finalized with some of the managers, we haven't lost out on the asset class exposures because we have these passive exposures, whether it's the small cap, whether it's the emerging markets, we're still getting that market exposure. So you can see that emerging markets have been a solid source of returns. Small cap has been a solid source of returns. The pyramid strategy, Fidelity, has been a good source of returns, and then the infrastructure has been as well. And then Ernest Partners, you'll see that Ernest Partners was a little bit of a detractor, as was the REIT exposure as well. And then overweights and underweights relative to target, nothing surprising here. The private equity allocation still is taking time for the capital to get called and invested. So that is the most meaningful underweight. And then as we think about the overweights, your international markets started off the year extremely strong, so they were naturally more overweight relative to the domestic market. We'll skip through this here and then the asset allocation. So let me pause really quickly because I wanted to use the asset allocation, this slide, to dovetail into comments around what's in the portfolio, what's defensive, and so on. But I think this also just marks the conclusion of Section A once I go through this section. So once I do that, would you like me just to go straight into the infrastructure education, or would you like me to pause and see if there's any questions
Yeah,
regarding?
let's pause for questions, and if none, continue on.
Okay, perfect. So with the asset allocation, very quickly, you'll see here that we did a couple of things. We ended up, bringing down fixed income a little bit. So why did we do that? At the end of the day, fixed income, we've seen more volatility come from the asset class, particularly as there's been uncertainty around where interest rate policy is going. What did we end up increasing in the portfolio? You'll see that we ended up adding private equity and infrastructure to the portfolio. And then on the real estate front, you'll see that we went from public REITs, which are equity exposures, to your private real estate. You'll also see on the international side we incorporated a little bit more diversification when you think about large cap, emerging markets, and small cap. So all in all, if we look at the overall portfolio, the defensive pockets are going to be your real estate core, your infrastructure, and private equity. Even though there's more risk in private equity on a standalone basis, if you have private equity within a diversified portfolio, you're actually lowering some of the overall volatility that you expect in the portfolio over time, because this isn't valued on a daily basis. And then fixed income still remains a quarter of the portfolio. So all in all, those are the more defensive components of the portfolio. And I'll pause and see if there's any questions regarding that quick overview.
So why we went, why we have zero for the hedge funds?
Yeah, I was going to ask you about that.
Yeah, so that was the old allocation, and the hedge funds under the old allocation, they were very expensive, and the performance wasn't that good for us. Okay. And we redistributed those returns to other segments of the market, private equity, infrastructure, and so on. So that's why we went from the 8% allocation to 0% in hedge funds.
Same thing with the REIT.
And then with REITs, yes, we will be transition. So we're still in REITs now because we haven't selected the private real estate manager, but that would be for the same reason. REITs have more volatility. They're traded on a daily basis. Private real estate isn't traded on a daily basis. There's also a cash component from your core open-end real estate. So, it's more conservative from a return stream standpoint.
Now, why are we so low on emerging market even though the yields are better?
Yeah, so with the emerging markets, it's a component of risk as well. So emerging markets, the prospect for emerging markets has always been very, very good. But when you throw all the emerging markets and how the index providers define emerging markets, you're going to find that it's a portfolio that's very big on China, South Korea, Taiwan. India is now creeping in as a major player. But it's a very concentrated portfolio based off how.
Very few players.
Exactly. So even though emerging markets on the ground, there are huge opportunities to make money. How people access the emerging markets through the equity market, it hasn't been able to keep up with the US equity market. So that's why it's a smaller allocation, even though the prospect of emerging markets is good. Now, I would also say that your non-US equity large cap also has a component of emerging markets to it under the ACWI ex-US as well. So there's still a little bit more emerging market exposure that's not captured in those numbers that you'd see in the large cap non-US equity allocation. So around 20% of the non-US equity market is emerging markets. So around 20% of that 15% would take us to about 6% in total on emerging markets, all in all, in terms of exposure that we have currently.
Let me ask you one question. Based on the flight of wealth from GCC countries, especially, the real estate, where you see that shift coming to Europe?
So this goes back to the comment made earlier about long-term versus short-term. I would say that sometimes where those monies move, it may be more intermediate term. And then the other thing is some of those monies may not be institutional. So it's your wealthy families and family offices that are moving those funds. And, the investments that we're in, even if the upside isn't as big, the opportunity set is a lot more consistent over the long term. So that need to move assets or divest assets from one country to another, that there's not that pressure on the investments that we have. So, yep. Okay, so here, let me pause and see if there's any questions. So I just went through portfolio performance, went through the positioning of the portfolio from an asset allocation standpoint. These are just quick summary slides on where we've been with respect to managers selected and asset class discussions that we're having and which asset classes selections have been made on. But let me pause and see if there are any questions regarding anything that I just went through. Okay, no questions. I can go into the infrastructure education and infrastructure here. So very quickly, we have Cohen & Steers in the portfolio, listed infrastructure, meaning that these are stocks of infrastructure companies. What we're looking to pivot to are private infrastructure investments that bring down the volatility and increase the cash yield expected in the portfolio. So, you heard from 3 really good managers last week. Won't go into that, but we'll really just go into what they represent in terms of the asset class. And again, from a timing standpoint, while we're not market timers, this is, in our opinion, a very good asset class to be in. And we'll go through the reasons for that. So firstly, infrastructure, as expected, these are the large physical assets of the essential goods and services that we all need. The backbone of society operates on infrastructure assets, airports, toll roads, railways. These are all examples of infrastructure investments. You'll find that these are the very attractive things attributed to infrastructure. So long asset life, meaning that these are big capital investments and they last for decades. The low elasticity of demand basically means that these are essential goods and services. So across an economic cycle, the cash flow predictability is pretty accurate. There's regulatory oversight, which is a way to say that, you know, pricing and the monopolization of certain assets and goods and services, those are regulated. But all in all, you're looking at stable and predictable cash flows. That's one huge benefit there as you think about a portfolio like this. Inflation protection, it is weird how, you know, a couple of years ago, 6, 7 years ago, inflation was this benign thing. You think about 1%, 2% here and there. Now we're in this environment where inflation is real, right? Again, we've spoken about the prices at the gas pump. We've spoken about how much prices have gone up, whether it's you know, house prices, whether it's education prices, and so on. And this type of asset class has a positive correlation with inflation because it's an essential good and service that's being provided. So with infrastructure, very quickly, you'll see that there are broad buckets that we put infrastructure in. You have your transportation, energy and utility, communications, and then your social infrastructure. So again, very broad as we think about those sectors that managers invest in. As we think about the characteristics for infrastructure, the type of infrastructure that we are looking at for this portfolio will lean heavily on what's known as brownfield infrastructure. So your greenfield infrastructure, these would be your new infrastructure assets. A lot of the times, the managers are just breaking ground. You're looking at cash being locked up for a significant period of time, and it will take a while for the investments to start yielding because these are under construction. Brownfield, these are your mature, already yielding, already got the cash flow ongoing types of assets. So brownfield is really where you know, the managers you just interviewed with and where we're leaning towards. Brownfield is the part of the infrastructure spectrum that our portfolio would heavily lean towards. As we think about the types of infrastructure assets, again, you've got your throughput assets, just basically meaning that you know, per use, there's a fee. So going to the airport, using a toll road, using a railway, all of these are just you know, essentially effective ways to print money. People need to move from points A to B. So again, a very good investment as you think about having exposure to something. Your regulated assets, you know better than everyone else. Regulated assets are a core part of the infrastructure story. So utilities, water and gas, these are also part of the makeup of a infrastructure portfolio. And then contracted assets, these could be your public-private partnerships, but ultimately these are opportunities, whether it's telecommunications, whether it's data centers, these are the opportunities to also participate in the infrastructure story, and again, diversify that revenue stream as we think about the different sectors and the different exposures. So the opportunity set here just points to how big the infrastructure opportunity set is in the US. I know we've been talking about it for a long time, a couple of administrations now, but the average scorecard, I think, for your US infrastructure is a C. And if you think about infrastructure, it is not only an essential good and service, but it's a national security discussion, right? Having those safe toll roads, having those bridges operating, having, you know, your light rail, all of these are also competitive advantages for any country to have. So the opportunity set continues to be an extremely big one, and participating in that opportunity set just means as an investor, we have the opportunity to really partake in growth opportunities as well as good cash yielding opportunities for the portfolio.
So you're saying in the US, we have a potential of making investments that would give us a good return compared to other countries, Europe?
Yes and no. So I would say that the U.S. just broadens the opportunity set. So infrastructure as an asset class is extremely popular internationally. So Australia, New Zealand, you know, many European countries from the UK, Spain, Italy, Germany, so on, have big infrastructure markets. But the US is such a huge market that it suddenly expands that opportunity set a lot more. So the U.S. involvement the increased U.S. involvement is good on a number of fronts. Yes, there is upside. I can't really say whether that upside is more than another geography or another, but I can say that upside is broader, and that broader opportunity set just gives us more opportunities to really partake in credible, robust and repeatable sources of getting return on income.
Yeah, because in 60 Minutes this Sunday, they talked about rail from Los Angeles to San Francisco, how long it's been going on.
Right.
It's been billions of dollars to go nowhere,
Right.
right? And they're doing
Right.
some stuff in Florida, but I don't know, the participation with the federal government, private industry, it seems like it's up in the air.
Yeah, so
Yeah, but on the other hand, if you see our infrastructure is way older, it's time, I mean, it has really, lot of it has already outlived its
right.
useful life.
You see
And
that
they
in
are,
New Orleans.
I mean, look,
Go ahead.
so what he's saying, I'm just backing it up. You can put 4 Europes in America alone. You have that kind of opportunities. That's why it is an evolving market with a better long-term returns.
So I want to also make clear, I love this market, but with all of that, and you saw the trillions over the years, these large numbers, this is still not what is targeted for huge returns. This is consistent, smooth out volatility, doesn't go anywhere. As big as it is, can we get 10%?
Yep.
11 is lanyard,
Yeah.
right? And so, but that also makes me wonder, one of the presenters, I won't name which one, they have another fund that I was kind of shocked, an infrastructure investor, and saw their location in Brazil and Turkey, right?
Right.
And so when I think about what makes sense, all the opportunity, brownfields, greenfields, not the fund that they were offering us, but do we have opportunities? Because if you do get infrastructure in emerging markets or frontiers, then yeah, some of the fastest growing economies are some of the oldest cities in the world.
Right.
Do we have any exposure to that in another asset class? Because this isn't it. This is not the make a lot of money asset class.
Okay.
This is the protect us asset class.
Correct. So that would be on the equity front.
Yeah.
Your traditional equities, your stocks, your stock portfolio. That's where that tangential exposure to those shooting stars. That's where we'd look to get that exposure, and it would be so diversified that it's again more suitable for a stock allocation. Yep. And as we think about where we would be. Think about the managers that you interviewed with. It would be a culmination of everything on the page, but perhaps a little bit more leaning to what's on the left-hand side. But then what's on the right will kind of bring the returns to the middle. So they will take a little bit more exposure to your airports and communication towers if there's a very, very credible theme and story. But the bulk of the allocation you're going to see in your steady, more boring brownfield type assets. So here, benefits versus the risks. Growing opportunity set. We just discussed that both here and internationally. It says potential hedge against inflation, but if you look at infrastructure and real estate, these have correlated positively with inflation. So they continue to be a good diversifier as we think about an inflationary environment. Strong and consistent performance. Again, that's the key theme. We're just looking for steady in the portfolio. And then low correlation to other asset classes. That means that as we have discussions about the market selling off, some of the headline risk with the Fed and what it's going to do with interest rates, there's a part of the portfolio that's largely immune to all of that. And then as we think about the risks, the risks, I would say, we've looked to mitigate those risks, and that's why we had the managers that you met with present to you. And then we had the RFP process, and we went through the procurement process. So these risks are generic, and we've looked to strip out and manage those risks as best as possible. So when you think about liquidity risk, all of the managers are open-end, meaning that those managers ultimately have more liquidity than your closed-end managers. They're in brownfield, so less of a concern about liquidity. Currency risk, these managers, these are large managers. There will be currency hedging options, for example, so currency risk taken off the table. Financing and interest rate risk, they're not financing big portions of the portfolio. What they're actually doing is owning as much as they can without using debt or leverage of the infrastructure assets. So again, a lot of these risks are being managed through the manager selection process. But with any investment, yes, there are risks, but going back to the comments that we just made, at the end of the day, we're looking for the more conservative, the more steady type of infrastructure investment. So that mitigates all of these risks that have just been laid out here. And then performance, we obviously always have that indicator. Past performance is not an indicator of future performance, but at the same time, it kind of is an indicator of what you're going into and what you can expect, right? So
It shows that past performance is.
yes. So, I mean, the takeaway here is unless the fundamentals of the market change tremendously, you can expect this type of relationship between your infrastructure and your other asset classes. I think that's the cleanest way to explain it. And you can see that infrastructure here is somewhere between what you'd get from equities and better than what you get from fixed income. And then as we think about real estate, it's a really good diversifier to real estate. So as we think about the portfolio, that's the behavior that we're expecting from infrastructure in the portfolio. So equities, S&P 500, ACWI US, that's the part of the portfolio that should really, really swing for the fences. And then your infrastructure, your real estate, that's your more consistent and steady source of returns. So here can add value to a portfolio, and that was just shown on the previous slide. This is just shown in a different diagram. And then the yield, this is listed infrastructure, but still it's a good proxy just to say that the yield, how much cash you get from infrastructure, is a good source of return, meaning that we are getting stable flows of cash coming in, which brings down the volatility of the portfolio. And then the correlation matrix is basically telling us how much movement can we expect between infrastructure and other asset classes we have. And you'll see that infrastructure has pretty low correlation to the major asset classes. That's the big takeaway here. There is some correlation, meaning that yes, the equity market will have some type of directionality with how the infrastructure portfolio moves, but you're getting that diversification. If the equity market sells off, you're not looking for complementary behavior from the infrastructure portfolio. The infrastructure portfolio should actually behave in a slightly different way. So again, you're getting diversification, which goes back to that downside protection that we were just mentioning earlier. And then how to invest. We're already in listed infrastructure, so the good news here is it's liquid, it's transparent, it's traded on a daily basis. You'll see here that it's a limited opportunity set. There's an equity correlation, so the market volatility is something that we do feel. And then as we think about the private infrastructure, we're looking at an open-end fund. So that open-end fund allows us to have a little bit of diversification, a little bit of liquidity, and then the fees are pretty competitive. And the conclusion here is we've just gone through it. Good asset class to be in, the diversification, the cash flows, the duration matching. So we are long-term investors. It's a long-term asset class. And then as we think about the opportunity set, it's a growing opportunity set for us. So that would be the infrastructure overview. And then the last part of the presentation would be the contract updates. So we have Loop, Ernest, Channing. These contracts are behind us, so that's the quick update there as we think about the contract updates. And then with the managers under the unsigned column, really good progress has taken place. I want to say between the CFO, legal, the Marquette team, a fire has been lit between the legal counsel on some of these managers' sides, and things are moving along, a little quicker. But anything Mary, that you want to?
No, this pretty much summarizes it. GQG, the documents, I believe, are awaiting execution on the GQG end. The legal documents have been signed. There were a couple of forms that awaited some check boxes and signatures, and those are in process. Mesero MetLife, we are awaiting response from the legal team on MetLife, on the language that we needed to make sure that we properly documented the selection of the Mesero team that moved to MetLife. And TSNW, that's in queue to be signed. So,
Ezra was almost a year ago.
How long have these contracts been unsigned?
they've been in process for, I'd say, I'd have to look to see when we got the first request to process those and got the documents from each consultant. Maybe a year. Kweku, do you know when we first got the first
I think
document?
Is that normal or abnormal?
It's normal. It's normal for a public entity, just because the legal teams of the investment managers, whenever you go through the procurement process, we can sign, we can go through this, no problem. But then when it comes down to actually signing the paperwork, there can be a back and forth. And, in some instances, it's very straightforward when you're thinking about index funds. Index fund, we had no issue having that paperwork up and running. But the more nuanced, I guess, the asset class becomes, sometimes it can be a little bit of a protracted conversation. So I would say that this is on the longer end, but this is not a rare situation that we're in. I've, again, gone through situations where it's been, a year and a half going on 2 years on some contracts, which thankfully we're not even, it looks like we're not going to be even close to.
I wanted to reiterate my point. If any one of these prospective managers have issues following our rules,
Right.
so they should not be even considered, because wasting a year and a half, maybe in other sectors may be good enough, but not in our entity.
Agreed. Agreed.
We cannot wait forever and go back legally, handling their minor rules and regulation. If they are not comfortable playing alongside our rules, then they shouldn't be even considered.
Agreed. And I think on the infrastructure side,
I hope with this infrastructure
We did something
managers
upfront,
coming
right?
in, we won't have any back and forth.
that's the expectation. We've had, very detailed discussions with them.
I mean, we should really lay out our rules
Yes,
for them to adopt, not for us to adopt their rules.
absolutely. It's your money at the end of the day, so I concur with that completely. Yeah.
So in the future, please, just go through a better and minute scrutiny and tell them that, look, this is our rule of play.
Right.
If you don't like it, don't even entertain.
Yeah,
Absolutely.
I think that we've addressed, this has been painful. I think we've addressed to the point where we had someone in the last process removed because we have put these qualifications on the front end versus the back end,
Correct.
right?
Yeah, so it would have been 4 managers, but then one of the managers.
Yeah, yes, sir.
Right? And so with that being said, to kind of level set our expectations, is it realistic? Because I understand about MetLife, that's an anomaly with the acquisition. But by our next meeting, how confident are we that the other two, GQG, I think, will be done? Or can we even set that expectation? Are we at the finish line or?
I think we're at the finish line with any of the legal documents. I think
Yeah.
it's the matter of getting them actually physically processed and signed, and then some of the signatory specifics and some of the checking of the boxes.
Okay.
Yeah, no, we should be
Had an
completely.
unusual
definitely by
request,
the
and they
next
were
meeting,
handling
so.
that.
Okay, so we feel like next meeting, like I said, I get MetLife, but the others, we think we're good.
Yeah.
Okay.
Yeah, and part of it was, and to me, you know this from the discussions that were had, was the structure of the mechanism to get involved in some of these, because they were the board is becoming a member of the LLC entity that owns the
Asset, yeah.
asset that's managing, and so that's that's what has caused some of the questions. We're not just engaging the manager with a managerial contract. That was done with some of the others, which was a more simple approach.
Yep.
That's not been the case with these, and we'll see what happens. JP Morgan did take itself out of contention because they couldn't sign the side letter agreement that we required.
Yep. Great, thank you. All right.
Quaco, with the managers that we interviewed recently, Marquette is still gonna give us a recommendation?
That is correct. That would be, I think that's the expectation from your guys' end. I think the goal would be to come with a recommendation. They're all good managers, but obviously we can't invest in all of them. So the expectation, I think, would be for 2 managers, and then we would highlight which combination of the 2, in our opinion, would make sense. And we'd also, again, want to reiterate, you know, thoughts around the contracting process and so on, the operational side, as well as what they're going to do in the portfolio as they come in.
And Joe, we don't not necessarily have to wait for Quaco. If you see good things in those presentations, you can make a recommendation too.
Sure.
Yeah. Okay.
All right. Where are we next? Let's see. Oh, that's where we are. The update on the transition, this is it, Kwaku?
That was it.
Okay, that's it. All right. And any other questions, comments on that? All right. We have 2 information items for everyone to review at their leisure. Are there any public comments? No public comments. Thank you very much. Being no further business for this committee, I'll entertain a motion to adjourn. Moved by trustee McBool, seconded by Director Thomas. All in favor? Aye. Meeting adjourned. Thank you very much.
Thank you very much, sir.